Hi, it's Tom from Franc. Despite the political and social upheaval in South Africa right now, this video is not about Gandhi's political movement. Rather, it concerns the growing resistance towards passive investment in the market. First of all, passive investment, as opposed to active management, is any investment that does not require an investment manager to make regular decisions on behalf of the investor. Instead, these decisions are based on an algorithm that decides what gets bought and sold. A good example of this is an index tracking equity fund, like Satrix 40 ETF, which tracks the top 40 largest companies on the Johannesburg Stock Exchange. The criticisms of passive investment and these types of funds go something like this. Firstly, fixed algorithms mean that the value of each company isn't really considered, which can distort the stock price. Secondly, indexes, including options and derivatives, can break under stress, causing loss of money and further volatility. On a whole, I disagree with these points. As is often the case, it's more complicated than people think. For the first point, two assumptions are made here: that all passive funds use the same algorithm, and that this could affect the liquidity of the market. In other words, not enough willing buyers or sellers. But these assumptions are both wrong. Not all algorithms are the same, and passive investments have a 45% share of the US equity market and only 18% globally. So it's highly unlikely that passive investment will distort the market in the near future. The second point of resistance has some validity, but only for synthetic indexes that don't buy or sell the underlying shares. Instead, they track the index by trading in complex financial derivatives. This proves my first point, that not all indexes are made the same, and also why it's so important to invest in high-quality passive funds. Passive investing is disrupting the investment market, as its fees are much lower than those of active management. This can sometimes be as low as 0.01% compared to 4% for active management. The loss of fund managers' fees is likely a driving force behind the growing resistance to passive investing. So don't be fooled. Unless you're investing with Warren Buffett's Berkshire Hathaway, with its dizzying $345,000 share price as of the 2nd of December last year, for most of us, tracking the best of the equity market through a low-fee ETF is the smartest way to invest. I hope you learned something from this video. If so, why not check out some of our other content? Thanks for watching.